closing sharply higher after this morning's December inflation report showed core inflation came in slightly less than expected. So what does this mean for Fed policy this year? Joining us now is Loretta Mester, former Cleveland Fed president and a CNBC contributor. Loretta, it's great to have you back on the show to talk about this. That is where I want to start, is the CPI report we got this morning, because it really was the month-over-month core CPI reading that helped spur this rally in the market. And yet, in general, we have been seeing the pace of inflation pick up and stay very sticky above the Fed's intended target for a number of months right now. So how does that position the Fed at a time where already investors are expecting we could have a holding pattern?
Well, I don't think that today's report on inflation changes that much in terms of the main theme. I do think that it takes out some of the scarier scenarios on the upside on inflation that the markets were worried about, and I think that might explain some of what you're seeing in the markets. But, you know, if you look at the economy overall, right, economic growth and the labor market are quite strong, and inflation progress has stalled. So the FOMC needs to be really focusing on how the economy is evolving over the medium and, term, not looking at every little data report and changing its view on the economy based on one report. Those monthly data reports can be very volatile. And so there wasn't really much in the report that would say change your view that, we don't really need to be cutting rates at this point, and let's give it some more time so we can assess where the economy is and where it's going. And, one of the things that we saw when they started cutting in September, they were really they were worried about the labor market. They basically had concluded that inflation really has made a lot of progress, and they were more confident it was on that path to back to 2%. But some of those, the data reports that we got in the summer towards the fall were a little weaker than they wanted to see.
Yeah.
And they were worried about that. What happened, though, of course, is those reports were revised up, and the subsequent reports show a labor market that is very, really healthy. And so concerns about the labor markets have been revised away, and what we have instead is concern that maybe the progress on inflation is stalled. So there really isn't a reason, looking at either side of the mandate, employment or price stability, that the FOMC would want to cut rates at this point. I think it's better for them to wait and assess things.
Okay.
And it doesn't cost them much to do that at this point, given how strong the economy is.
So given that, what is the bond market telling us right now? And I ask that knowing that some of the larger moves higher we have seen in yields in recent days and recent weeks have been at the long end.
Well, a couple of things, I think. I think the bond market is reading the economy as being strong. And so they're projecting, we have a strong economy. We may get fiscal policy in order under a new administration, and potential growth may be going up. We've seen productivity growth higher. So they may be saying, we have a higher potential growth rate economy now. Coupled with that should be a higher, normal interest rate or neutral interest rate. And so that's part of it. Part of it, I think, is uncertainty about inflation. It may not be the inflation expectations are higher, but I think there's more uncertainty about the path, and that feeds into term premium and those bond yields. So I think it's a combination of things. But I don't think they're wrong. I think that we just have to wait and see what is the path for economy, what in particular is the path for inflation, and whether the Fed needs to change the narrative that it's been having, which is we're going to bring rates down further, or whether really that normal, neutral economic, equilibrium interest rate is higher than they think, and therefore policy is less restrictive than they think.